Welcome back. You're watching HFO-TV, co-sponsored by AMF Capital, the Bald-Janik Law Firm, the Butler Exchange Group, and the construction firm J.R. Johnson.
Welcome back to HFO-TV. I'm Greg Frick, partner at HFO Investment Real Estate. Here again, we're talking with Tim Steele, director at AMF Capital. It's been about a month since we talked last time, Tim. The last time we talked was right around April 1st. Now we're almost at the end of April. So we kind of went a little in depth of what kind of was changed with the pandemic and all that. But first off, I want to say, thank you for coming, and hopefully everybody's safe and doing okay with your family and all that. So
yeah, you bet. Thank you.
Maybe kind of give a rundown of what's changed in the last 4 weeks. I know there's a lot of questions. We just did an interview with a 1031, Toya Bueller, 1031, and she kind of explained a little bit about maybe them extending it, but not kind of the way they wanted to. So I know everything's in flux, hence why we're kind of probably getting together and doing these more often. But maybe give an update of what's changed in the last 4 weeks.
Yeah, we can start right there. I mean, our first video, we weren't even sure if 1031 was going to get the blessing to extend. So we now know that we have extension till July 15th, and you guys talked about that. So was she referring to yet another extension?
Well, they're hoping that we may see, they're hoping by the end of May that it's not, I guess from what I understood is when we've had these events before, they usually just do an extension of days. So it went from 180 days, you got an extra 120, so 300 total, as opposed to this hard date of July 15th that she brought up. She had a client that has one that they've got to close by July 13th, so they got an extension for 2 days. They're hoping they're going to get some maybe more specific terms of the extension, specifically for 1031s, where it's added days, not a hard date. So we'll see. She thinks she'll know, and then again, probably the end of May is the hope on that. So,
well, that would be great. I do think that extension did kind of, hurt some purchase business for sure. People aren't under the gun and they have more time to think, and if this is all temporary. So we've learned that in the last 4 weeks. But yeah, purchase business is basically dead on my end, on AMF Capital's end, and even some of my cohorts in the industry on the lending side. It's just all refinances mainly right now. And those are even, down quite a bit.
Now, is the refinancing because of, we talked in, it was April 1, the 10-year had jumped up and now it's back down. Are you seeing rates, now again, it's relative towards loan to values and loans, but are you seeing rates have come back down a little bit?
Yes, that's the good news. We are seeing the spreads came in because as we know, when it almost hit zero, we kind of talked about, okay, why are the rates almost 5%? And, those are floors and lenders protecting themselves with profit and slowing down application volume, whatever the reasons are. In the last 4 weeks, with government intervention, with buying back multifamily bonds, as well as keeping liquidity moving for residential loans as a whole to keep the economy not so hard hit, we did see investor spreads come in. So yeah, interest rates, I would say probably for your smaller loan amounts, your higher LTVs were around 4%, 7-10-year money. And right now, I mean, Fannie Mae, if you're at a 65% or even 55% and lower, I mean, they're below 3.5% today.
Wow. Okay.
So yeah, they've come down considerably.
Oh, that's great. So one question that keeps coming up with a lot of our clients on the financing side, even on the refinance, how are you? I know in April the collections in multifamily in this market were significantly better than what's some of the people had predicted they thought they were going to be. I mean, I think we averaged probably around 8 to 12% of some kind of collection, where people ask for help. What are you saying in terms of, hey, I want to do a refinance? What are we looking at on how they're underwriting? Again, multifamily, commercial is a whole different deal with retail and office. So,
of course, well, that's an easy conversation because commercial's dead. As for anything, what I'm seeing is it just depends if we're hitting that threshold of the debt service for the loan request. And so I did speak with some lenders recently because I haven't done a ton of volume since just a month ago. But I agree. I talked to clients around April 7th, and they were telling me right around 7-8%. They weren't getting quite hit as hard. And we'll see what May brings. But right now, the worst thing I'm seeing is twofold. One of our retailers asked for whatever rent rolls used for pro rates at close is shipped up to underwriting and looked at and approved before they'll release any loan funds. And so not every lender is doing that, but historically they approved the deal, and whatever the rents were, they were comfortable with full underwrite, and here's your loan. So they're keeping an eye that nothing has dropped off from the day of final approval, refinance, purchase, whatever. And then, our main lenders right now are Fannie Mae, Freddie Mac, HUD, specific to faster deals, Freddie Mac and Fannie Mae. They're just asking for trailing 3 months of collections on their own form. They're not asking sellers for bank statements. I think that's one thing we kind of had a theory around. They may get a little invasive. They're not doing that yet. So really, they're asking either the owner on a refi or seller to fill out what their collections have been, a little more detailed than just a rent roll, and certifying that and going to close. It's actually not as bad as we talked about.
Right. We thought, when we first talked, we had thought maybe there's going to be some issues on, how they're going to deal with that, and maybe, as you said, more invasive and more restrictive. So that's good.
Are you guys seeing any purchase business? I'll throw a question out your way real quick.
Yeah, what we're seeing is transactions that were in place before are still going through. What you're seeing now is there's not some talk of people needing to do something. A lot of times it's if they've got other product types that that are dragging in and need a liquidity event. But from a going to market, we've basically kind of put everything on hold and said, let's revisit, May 1st, probably going to be now a revisit of May 15th. When do we go to market? Let's look at doing that. We have a number of properties that are ready to go to market, that are listed and ready. We just said, let's put a hold on it. Twofold: one, what's going to happen in the lending environment like we're talking about. And then two is, just the due diligence period of how do we go through due diligence. This isn't a commercial building where we can walk in after hours. How do you go do due diligence in a multifamily property when you have tenants living there? So that's another reason why it's like, hey, let's just kind of, in terms of long answer to a question, transaction volume, it's almost going to be kicked out a quarter just because you're not seeing product getting on the market.
Yeah, and that's what we're experiencing. Like I said, I don't want to sound too grim, but purchases are just dead right now. Anything new from when this pandemic started? There are some stuff wrapping up. Maybe they had extensions from prior to all the changes. And back to, I think we even mentioned time on the first recording. That's going to be true to your point, is how do you go in and make sure tenants feel protected? The inspectors feel protected. Aside from what the law says, people can raise their hand and say, I don't feel comfortable going in. And so do inspections get delayed? I don't know the answer to that question. I haven't heard of anything drastic, but I do know it's taking a bit more time to schedule these inspections.
Well, I know we've done a couple of appraisals for these deals, and it was interesting talking to the appraisers, twofold as to what their client, quote, the lenders are allowing them to do. Maybe they're not going to get into 10% of the units. They're going to get into the 1 and 2 vacant. They're going to take in photos from the owner, photos that we have, and see if that's acceptable. So if I was asking one of them, do you think that may be the new norm moving forward? If you get enough, digital information, that do you have to physically go into 10 to 25% of the units like the old day? I don't know. We'll see what happens when that changes. So
I've heard lenders are being flexible. They obviously want people's safety to be top priority. So if it turns out something near Seattle and King County might be a little more, we'll take your videos and your photos so long as somebody from our firm, versus maybe in places like here where I live in a smaller town, they may be like, can you get at least 5 units out of your 20 as an example? So I think it's case by case, but lenders have been, for the most part, at least I'm hearing, pretty user friendly on not stalling the deal because someone couldn't see 10% of the units or whatever their requirement is.
So the thing I was just thinking now when we talked about appraisers and the kind of valuations and what those look like, on the refis that you're doing and going in the queue, is it that the valuation's not because the LTV's low enough that there's really not a question of trying to max leverage the deal? So there's this, because we get asked about what the values are, and somebody's asking me today what the value of their property is. It's kind of like, okay, what's going on? Because we don't know what the discount's going to be. We don't know where the collection's going to be. So it's kind of an interesting deal. So
I have hope that if we go back to some normalcy, close to what we were before all this happened, not the normalcy and getting back to work and getting the economy back to its grim pictures now, is do we just count it like a capital expenditure? Historically, if you had something that wasn't recurring, you added that back to see the true profitability of the property. Are we going to do the same with economic vacancy? If the tenants didn't move out, they're going to see, I can envision lenders looking at rental agreements, or at least the dates on a rent roll, and going, yeah, nope, this tenant needed help. They're back to work paying rent. We're not going to say this property needs to be underwritten at 10% vacancy when it's full, right?
Yeah, well, you're going to take, you take a trailing 12 and say we're December of 2020, we take the trailing 12, and that trailing 12 we take out, say it's April and May, or May and June in multifamily, where we had some, collections were down, and we don't really use that in the annualization of what, we look moving forward. So that's kind of, hope that's where it goes. I think it all depends on the time and how long it goes for. So
right.
Our owners that have mixed use, that's a different story. On the mixed use projects, how, again, we do a fair number of those, but how that retail and or, commercial use, that's a whole different deal.
Yeah. Well, and I think buyers too, from some I've talked to, they think there's going to be blood in the streets. I mean, it's all a gamble right now on, do you wait? Appraisers are telling us this is temporary. They're still saying they don't see a huge impact on values, obviously meaning cap rates moving up. I don't think interest rates are going to go up, only if there is a liquidity issue in the background like we saw on April 1st. But so long liquidity stays moving, whether it's government intervention, investment into our government debt from other countries, we still have attractive returns in all things going on globally from other countries. And so when that money moves here, I don't think interest rates are going to be the correlation for cap rates to go up. And so I'm pretty confident values will stay decently stable if this truly proves to be temporary.
Right. No, I agree with you on that one. I think right now there's not going to be enough deal points or data points to kind of make adjustments. There's always some outliers, like, again, somebody needed a liquidity event for whatever reason and, are doing something like that. But I think if we get back to some kind of normal deal flow in terms of that, you may not see a huge adjustment based on, a 60-day or 90-day collection issue on, again, specifically speaking about just multifamily and not on the other stuff. Yeah. So, well, that's good. So, are you seeing on the lender side, I mean, it almost as if they priced in, or, when we first talked in April 1st, there was so much uncertainty. I mean, there's still a lot now, but it almost seems as there's a feeling that maybe you can see the light in the end of the tunnel in terms of, you're looking at rates down. It doesn't feel like there's such a liquidity crunch. Are you guys feeling that same feeling?
We absolutely are. We live on transactions though. And so, right now, again, purchase volume is down to non-existent, but refis are 55% LTV. If you're not asking for anything greater than that and the appraisal comes in favor, you're not required to do 12 months, 18 months reserve P&I at close. Everything stays pretty kosher is what we were used to before. And then up to 65 or even up to 75% LTV, they want that 12 months funded. And on a cash out refinance, they could take that from the cash out of their loan request. They're not
so they could take the cash out on the refinance, use that cash out for that reserve, and then in 12 months,
correct.
Get that back at some point, depending on how that's going to work out.
Yep. And I will say to your viewers here, because the government intervened with the multifamily bonds to keep liquidity moving, they did designate $3 million and above. So you'll see pricing disparities. If someone calls me and asks them to quote a $2 million refinance or purchase loan, there's going to be a 50 to 60 basis point disparity. And if someone were to get a quote on a $7 million loan with these same lenders. And so we'll see if that comes back down. And I think that's partly why some of the banks have just kept their floor rates high. But right now, the active players are Fannie, Freddie, and HUD, with exception to your small credit unions and things like that. But for the most part, it's not as grim as on April 1st.
Right. No. As I say, it feels as if things are, again, I mean, we're still social distancing, and I have my mask here, but we're not sitting next to each other. But it does seem that the movement and the tenor seems better. There's more of this is the lay of the land. It's always, as we've talked before, this winter's uncertainty is when things kind of freeze up, and now it kind of says, okay, we can kind of get a game plan out. The federal government's with the help with getting things liquid and more liquidity in the market. I think it's helped a lot. So,
yeah.
But yeah, I'm with you. We, transaction wise, until we start getting things kind of ramped up again and knowing how we're going to do due diligence and timing, it'll be a little dry for a while. I think people are getting geared up and ready. It's just going to be a matter of when they come in. So,
agreed.
Yeah. Well, thanks for taking the time again. Enjoy the ability to spend time with your family and things like that. And we'll be talking to you soon as as this thing continues to evolve and updates continue. Our hope is that we come out of this thing okay and everybody's safe, and that, as the news continues to get a little bit better, I'm not expecting some avalanche of great news and all of a sudden we're back to normal, but as things go better, hopefully the market will, go with there too, so.
Yeah, absolutely. And, I did an antibody test yesterday. I haven't got the results yet, but if you can get that with your doctors, go try, because data is huge right now. If we find out this has been around longer, and it doesn't have quite the same rate, we might be able to get back to work faster. And that'll be good for everybody.
Definitely.
Yeah, all right. Thanks a lot, Tim. That was good. We'll, be safe. And we'll see you again next time on HFO-TV. Be safe, everybody, and we'll talk to you soon. Thanks, Timmy.
Our entire office specializes in multifamily real estate, making HFO the largest multifamily brokerage in the Pacific Northwest. Your success is our passion. Build your legacy with HFO. Call 503-241-5541 or visit our website at hfore.com for more information.